everybody. Hello, everybody. So, in this video, we'll be talking about international arbitrage. So, arbitrage is mainly defined as profiting from price differences for the same asset in different markets. So, it is also considered as riskless strategy where international investors try to use the multiple exchange rates and then try to make the profit. So before getting into the arbitrage process, first you need to understand whether the arbitrage opportunity exists or not. So before getting into that, first we need to understand what are the different types of arbitrage. So one is the locational arbitrage, where you tend to exploit the price differences in the different location, and the triangular arbitrage includes the cross exchange rate inconsistencies, where you typically uh, three different currencies are involved, and in the location arbitrage you buy in one currency and sell in another currency, and then determine what's your overall profit or loss. And then covered interest arbitrage is mainly profiting from interest rate differentials while hedging exchange rate risk. Okay, so what we will do is we'll try to see one problem on location arbitrage and then try to solve it. Okay, so let's see this example, right? So in this example, let's say an investor has 20,000 US dollar, okay, 20,000 US dollar. Now he wants to understand whether the arbitrage exists between Canada and the US dollar. So the first condition before going for arbitrage is to understand whether the arbitrage exists or not. So what you need to do is you need to check the bid price and ask price. So if the bid price is greater than the ask price, then the arbitrage opportunity exists. So for example, in this case, the South Bank bid price is 0.730 and the North Bank ask price is 0.725. So the bid price is greater than ask price. So the first condition is met. So arbitrage opportunity exists. So bid price, you need to understand this is very basic. So bid price is nothing where bank buys a particular currency, and ask price is something which banks sell a particular currency. So for example, if you see in this case, North Bank is going to buy at 0.720 and they're going to sell at 0.725. So whatever the price difference, we call this as bid ask spread. Okay. So let's start the arbitrage process and try to see what is the profit here the investor will make it. So let's say the first step is we understood that the arbitrage opportunity exists. So now the investor has 20,000 US dollar. So that needs to be converted to Canadian dollar. Okay. So I told you that you need to check ask and bid price. So here the ask price is 0.725 US dollar for one Canadian dollar, right? So now you have $20,000. So cross multiply 20,000 US dollar divided by 0.725 Canadian dollars. Okay, so which means now you have, I have rounded off. Okay, so 27,586 Canadian dollars. So now you have this Canadian dollars, right? So maybe we can put here also for the better understanding, right? So you have 20,000 US dollar and you want to invest that in Canadian dollar, right? So just need to cross multiply. So if you cross multiply 20,000 divided by 0.725, okay? So which means you will have 20,586 Canadian dollars. So now what you should do is, again you need to convert back this to the US dollar. So now you have Canadian dollar, so which is 27,586, right? So you need to cross multiply. So here you have below the Canadian dollars, you have 27,586 Canadian dollars, multiply by US dollar 0.730, then you will get $20,138. Okay. So remember one thing here, in order to complete the arbitrage process in the location arbitrage, whichever the original currency you have started, you have to end in that currency only. So here the investor started with USD and he is ending in USD. Okay. And now the last step, what you should do is you need to calculate what is the profit or loss. So this is very simple, your NPV formula, what you have learned in capital budgeting, cash inflow minus cash outflow. So here cash inflow is nothing but 20,138 US dollar, which you made through the arbitrage process, and your investment is nothing but $20,000, which you invested initially, right? Which you invested initially. So your profit is $138. So what did you understood in location arbitrage is, the first step is to understand whether the bid price is greater than ask price. If the bid price is greater than ask price, then the arbitrage exists. Then what you have to do is the original currency, convert that to foreign currency, and again foreign currency convert back to the original currency, and then calculate the net cash flow, so which is profit or loss. So this is about location arbitrage. So see you in next video. Bye bye.